So, this is about residential financing. I just wanted to echo a couple points that were made this morning. We heard that we need an 80% reduction, an additional 80% reduction in order to achieve our goals, the state's goals. And that's a lot. And we're not going to get it clearly through just rebates and investments in energy efficiency through rebates. And until recently, financing, particularly in the residential sector, hasn't been that robust. But there's been a lot of change in the last few years, and things are happening. The question is whether we can make that happen on a more aggressive scale in the state and introduce new models and new approaches. And we're going to hear about a variety of stuff. There are several different models we have here. They're in different stages of development. So this should be an exciting opportunity. I'm looking forward to learning a lot about it. So back to Demetra. Demetra serves as the director of the Office of Sustainability and Climate for Santa Clara County. Her professional board and committee service includes the Local Government Sustainability Energy Coalition, the Joint Venture Silicon Valley Climate Committee, the Bay Area Climate Collaborative Steering Committee, and the Green Government Council of the National Association of Counties. She's very busy and very qualified, and we're going to hear about PACE. Thank you.
Thank you. For those of you who are coming in from the pavilion, just pretend I'm a tall, thin man and have a deja vu moment with Ken Alex's discussion. Actually, Ken and I have been speaking on a monthly basis for the past 6 months, so we did coordinate our discussion. So we're not going to be repetitive here. Neil? Obviously, the latest developments. For those of you who are not finding it, I've titled this PACE is hitting its stride because, as you know, AB 811 was enacted in 2009. We have had until the past year a somewhat sluggish response in that program, either on a residential, certainly on a residential for obvious reasons, but even on a commercial basis, is having real traction in the marketplace. In the past year, we have noticed that there is pickup, and it's having pickup mainly because there are implementers that are finally putting together programs that make sense in the marketplace. So the latest developments, obviously, as Ken said, there was a statewide loan loss reserve adopted. The FHFA May 1st letter, for those of you that did not read it, really kind of waffled on the proposal from the state, and it really tried to put in a pitch for subordinating the seniority of the assessment. That is not the AB 811 model. It's not the California model. And again, not to be repetitive, but as Ken said, with the securitization moving forward, with the vast and extreme pickup in the residential market, but securitization means that banks, and that's Deutsche Bank, so they're certainly credible in the international marketplace. But as these securitizations continue to happen, as the volume grows, it's really making the issues of any redlining from Freddie Mac or Fannie Mae really irrelevant and minimizing the risk to a statistical insignificance. So we also have the California First soft launch of residential coming in June, and commercial, which is really interesting. We have programs, and before I go any further, I do want to give credit to Sonoma County, our colleague, Liz Yeager. While really PACE was undergoing a fitful birth in the rest of the country, there were a handful of communities, and the primary one was Sonoma County. That model could not necessarily be scaled up across the state or the United States because they put their money where their mouth was, and they put $100 million. I spoke with Liz this morning, and they still have around $12 million in cash because now they're getting payments that are coming in, so they're able to rotate to a certain extent, but they are going to an open market. There is an uptick in California First applications. The Fig Tree portfolio is expanding, and the Los Angeles County program, which really is one of those programs that I say has a lot of the arrows that need to be in the quiver, and we'll go through that a little later on. They have recently launched, just within the past 7 to 8 months, their program. They already have over $7 million in projects complete, and they have over $42 million in applications. The other thing, and I don't know for the legislation geeks in the room, AB 1883, advanced by Skinner, I did look it up to get the latest progress on that bill. It is sitting in Senate committee right now. The word is that it is expected to pass. This basically, the existing Appropriations Act from 1911 in California allows local agencies to lobby special assessments in districts. their voluntary agreements, contractual agreements. They also include the ability to impose liens and to institute foreclosure actions if there is any failure, delinquency, or default on the assessment. That now is being expanded to allow local agencies to assign right, title, and interest in those assessment agreements to a third party. The reason that this is so important is because it will allow some of the free up in the time and money that's taken in bundling and securitization, and also in avoiding the extreme costs and a lot of the paperwork and having to bond, because this allows you to transfer those rights and those contracts if you haven't already bonded that project. So it allows kind of a fast track option. Getting to what I call the all arrows in the quiver model. This is, and Los Angeles County's model has a lot of these elements in it, and I'll point out where they don't. The owner operator facing collateral, this is for commercial. The contractor facing collateral includes a very, very user-friendly website where it automizes most of the processes as well. Tools and strategies for identifying target audiences. The SoCal REN has one, and the Bay REN now has one. It's what we call a market segmentation tool. It takes all of the buildings, commercial buildings, in each of the areas. It applies, in our case, I can't speak to Southern California RENs, but in the Bay REN, it's around 25 indicators that we're able to run through a tool. We're able to take single indicators or bundle indicators as they may indicate really a primary target for PACE financing and an upgrade. Audit incentives, they can either come with ASHRAE 2 audits or investment grade audits. Loan risk tool. This is a tool that Los Angeles doesn't have because it's just coming out on the market now. It's going to be a public access tool. Banks, for a lot of their loan products, particularly in this range, have what they call some kind of tool that measures loan risk, loss risk for them. And we didn't have it in energy efficiency. And that tool has been in development through a partnership between Navigant and I believe SCE over the past year. So that tool is ready to hit the market. It is going to give banks as well as financing institutions a level of comfort that they haven't had before. Also, project generation teams. These are people who have strong relationships throughout the contractor and relevant contractor industry and community. They have been very, very, very influential in the SoCal RENs program in LA counties. Flexible and responsive financing models and post-retrofit tracking and monitoring is something that we would love ideally to add on, just so as you heard earlier in Pavilion A, we really need to be able to get data, and it would be great to have systems that give us information discrete by measure. Residential models. Obviously, these are the products that now are available for these assessments. We have a couple of people in the room that are here. You can't speak residential in California without speaking HERO. So this is actually not an exhaustive list, but it's a primary list of what the HERO features are. I'm not here as a spokesman for HERO, but what I am here for is a spokesman for a meaningful, compelling, logical model in the residential marketplace with enormous amounts of traction. The contractor training, and as you're about to see very shortly, I actually did polling and surveys and interviews with a number of the HERO contractors because I wanted to hear what made the program more appealing, compelling, and meaningful for them. Automated proposals, most of their process is fully automated. Quality control, they also have a 24-hour, 7-day-a-week helpline that people can call into. Approvals that are based on home equity, so then they don't have to go again through a very long-winded and very document-heavy process. Long-term, low fixed interest rates. The contractors really found this to be really compelling because what it does is allows them to, with some element of certainty, to be able to work out a system that meets the consumer's needs, is flexible to the consumer's needs, but also gives them some certainty of cash neutrality in their home budget, their household budget. Private equity investment. We're all trying to move towards that model, and they already have it. And also, there are other elements to this program that are useful because the interest that is charged on these assessments is tax deductible. So as part of their contractor training, there's a whole list of really selling points and positive consumer advantages and homeowner advantages that are discussed. And the contractors that I'll talk to were not only quite astute, not only were they well-versed and articulate in these issues, but it was very interesting to me because without fail, the first thing they said was, we are pushing energy efficiency throughout the state. The second thing they said is we're stimulating the economy, and later you'll see why. I did ask, 3 minutes, I'm on track. I did ask all of those contractors what makes this program different. And I'm really focusing on program modeling because we can have as much ME&O money as we want to throw at a program that has no traction, and the ME&O will not change that. They said uniformly, and before I even finished the question, streamline the documentation, automate as much as you can, reduce the program criteria. And they said reduce potential for unexpected consumer surprises. For example, the CAS test in, which we know is a valid and meaningful safety measure, and we all understand that, and the contractors did as well. But they said it actually undermines your own argument, your own program, because what you're doing is now you're disrupting what the consumer wanted. You're disrupting their budget because you're adding on other measures. You're probably adding on an attic fan that now is going to increase their energy use and reduce their efficiency. So they said these are too many consumer surprises, and you can't be surprised when the consumer walks away from that model. And here I wanted to give you some of the impacts which I was furnished just a week and a half ago, and I just want to point out where these numbers are already stale. Total funded projects is now over 13,000. HERO program is doing $3 to $5 million worth of business statewide every week. If you look to the savings, this $433 million, this is the expected savings over the expected life of the improvement to the utility. So this is in lower energy bills. I was just talking to Hero, and I would love to actually go through an analysis where we figured out how much this translated into lessening the need for additional future infrastructure and plants. And I'm going to keep true to my 3 minutes. I wanted to keep it crisp. I will certainly take any questions that you may have afterwards. Thank you.
Thank you, Demetra. And now for something completely different. We have another form of a loan and financing. We have Lori Bamberger, who is the Executive Director of Saving Neighborhood Energy, an intermediary building cross-sectoral ventures in financing, energy, and asset building for moderate-income families. Previously, Lori was HUD's Assistant Chief of Staff, Deputy Director at San Francisco's Mayor's Office of Housing and Counsel on U.S. Senate Banking, and VP of Provident Financial. She has a BA from Dartmouth and a JD from Yale. And give me a moment and I'll open up your presentation.
Thanks. Hi, everyone. Thanks for having me here. I'll start before it gives me extra time. Saving Neighborhood Energy is a very small new organization that exists to seed financial products capable of helping ordinary families reduce their energy consumption. At the same time, we help them improve their housing affordability. As you've heard, I come from the housing side of the ledger, and over the last decade have moved more and more into the energy side of the ledger. And our organization hopes to make clear what are the needs of real families living in their homes. So we're developing two products, which I'll talk about both today, primarily on-bill repayment financing, which is a loan product with a unique repayment mechanism, and a behavior-based financial and energy savings product we call the MESA. So I'm going to spend 1 second on this. You guys know this slide. Buildings matter, residences are a big chunk of buildings, and single-family homes are the biggest chunk of residences. If we want to make a difference in that 80% state goal, we have to think about existing homes people live in, even though it's a very fragmented market and the amount that we can achieve per home is relatively small. Next slide, please. This is a slide I actually want to spend a little more time on because I was persuaded by the commissioners this morning talking about we have to figure out what real people living in their homes need and how do we get that $1 trillion in the room moved into the area where people will actually do something. So our organization focuses, for the most part, not exclusively in OBR, we'll talk about that, on families who we call low and moderate income, really families in the HUD world that live between 60% of the area median income and, let's say, 150% of the area median income. They are not low income. They have to be underwritable. They have to have decent FICO to get a loan. What we think is that they have small assets. We know that in California, 44% of all families are liquid asset poor. Liquid asset poverty is a different standard. It's how much you have in your bank account after your income might go away. These 44% of Californians only have about $5,500 in their bank account. That's relevant for us because it means how are they going to undertake a $10,000 investment in energy efficiency? The only way these 44% of families, many of whom, if not most, live in single-family homes, are going to get there is by having some access to financing, and that's what we're about. The other aspect is that these families desperately need these savings. California desperately needs these families, and these families, by and large, live in the oldest of homes with the least efficient of systems. And the most health burdens. We find they sit between, they have what we call the low and moderate income conundrum with regard to energy financing. Their income is too high to qualify for free grants and too low to be interested in or qualify for other financing that's out there. And that's what we've set out to do, is to solve that. My last aspect of the challenge is our work sits in between these three silos. Just to kind of give you one example, I come from the housing and banking world. We call people living in those residential buildings borrowers. The energy world calls them ratepayers, and in the HUD world we call them families. And we think that the regulations that emanate from each of these silos reflects that difference. And at the end of the day, our goal is to kind of make it seamless for the families living in their homes. Next slide, please. So we have two solutions. The primary solution is on-bill repayment financing. Next slide, please. This is what it looks like. We've all talked about it. It is a loan whose repayment is on the utility bill. It could be any loan. It could, in theory, be. Can't be a PACE loan that's already on your tax assessment. But it is a simple meter low-tech item right over here. This is an example of Portland Clean Energy Works, an early version of their bill. With a little sentence here that says, if you have a question about that line item, call, and on that line it's call the bank. We think that on-bill repayment financing, like PACE, offers an amazing solution to families. The reason is we think the perception of what this cost changes because it's tucked into the energy bill. It has the chance, doesn't have to be, but has the chance to be bill neutral. This long, amortized, ideally 10 to 15-year loan could make it, depending on where you live, at no extra cost or at a slight extra cost. So for a family that didn't have $10,000 in their pocketbook, even adding, let's say, $25 a month is still better than figuring out how to afford $10,000. We call it a seamless integration of the loan charge and the savings. Next slide. Unbeknownst to many people, OBR actually was authorized in the state of California in two different versions. In the first, in November of 2012, there was a pilot authorized for Marine Clean Energy, which is a community aggregator, to do a $5 million pilot, which is supported by state ratepayer credit enhancement at about 10% of the loan capital. The second, and so that's about 500 homes. The second is PG&E, was authorized to do EFLIC, which is a rename of it. It stands for Energy Finance Line Item Charge. This was in this landmark regulation that was issued in September of last year. It allowed a fast-tracked version with a separate pot of credit enhancement managed by CHF, the California Home Buyers Fund, and a long-term administration by the chief. The credit enhancement borrows from the single-family loan DLP, I'm spacing on my names, the loan program, which authorized about $25 million in ratepayer credit enhancement and about $8 million targeted to low and moderate income families. Our version of OBR, this EFLIC or Marin's OBR program, is different from what the state commercial OBR was talking about, in that there is no disconnect allowed. If you can't pay your loan and you default, you will not lose your electricity or gas in your house. You cannot transfer from one homeowner to the next. You have to repay upon sale. And there is no proportional repayment to the bank. The utility gets paid first and the bank gets paid second. So that's kind of the biggest difference, and it's exactly modeled after Portland's program. But that's the biggest difference from how other people talk about OBR. If you go to the next slide. This is where we are, and I want to introduce for a second Paul Blagbro from Union Bank, who's the vice president. We have 2 pilots in the works. Paul, do you want to stand up? And we have 2 pilots in the work. Our first with Marine Clean Energy was a $5 million pilot with First Community Bank, serving 500 homeowners. It has just launched. It was launched softly last fall. It is just starting to launch with marketing. It has ratepayer credit enhancement ranging from 5 to 15% depending on FICO scores. It is low cost, about 6.5% long term, between 5 to 10 years, and unsecured. And our PG&E pilot is with Union Bank, which we are working on a $15 million loan program, which is an enormous commitment. A goal of 1,500 homeowners, and we are targeting especially, but not exclusively, low and moderate income families in 3 pilot sites, which will include Santa Clara County, Fresno County, and another place in the Bay Area. We're talking to both San Francisco and Alameda County and a few other possibilities. Both of these programs offer measure flexibility in that you can fund Energy Upgrade California as well as single measures, but not all single measures. In the PG&E pilot, it's whatever's in the residential rebate catalog. Both of them are unsecured. We are hopeful that our Union Bank loan product will be under 7%, so very comparable to the Marin product. And both are going to be quality controlled, if it's not through the EUC program, by making sure that the borrower gets a permit. Next slide, please. So I'm going to try to go really fast. We think that the value for OBR is about perception for families and target. It's an unsecured product, which may be more appropriate for certain families who don't want to get this on their lien or risk what might happen in the event of a default. It is integrated and so easily affordable in the same utility bill payment that they're making every month. It can overcome the reluctance to act. LBNL just came out with a large report. I urge you to take a look at it on bill repayment, but I won't mention it right now because I'm limited in my time. Lenders, and we can talk to Paul and ask him loads of questions afterwards, think that even though there's no disconnect by being attached to the utility bill, that there is still more of a willingness to pay that bill before others, and so it's more secure. And also, even though there's no disconnect, many of the lenders that we were talking to have said that for reputational purposes, it's important not to turn off the electricity if a family can't pay their small loan here. So we also are very striving for a neighborhood-based focus with very strategic marketing and sensitive underwriting. Next slide. So there are some challenges. One is the complexity and noise in the marketplace of a variety of different loan products, which each have advantages and disadvantages. The other one is that OBR EFLIC depends on a complicated set of agreements between the utility and the line item, between cities and counties that are administering other local government programs, and for marketing and other record keeping. We recognize that families can't be asked to do too much or they won't participate. And there's potentially contractor burden that affects our program, potentially more than PACE, where we are part of a PG&E and a CPUC regulated pilot. The last is that the indebtedness depends on families being able to achieve these savings, and we're targeting low and moderate income families, so we have a behavior risk that we're dealing with. So some of our solutions are, next slide, we're really depending on local governments to help lead this pilot. In 1 minute. We need local governments to weave this financing into the programs you're already working with and make it work. The second is we need you guys to help us locate target markets. Next slide. Our organization is pioneering a behavior-based, performance-based rebate. What this means is if we want to make sure that low and moderate income families who take out a loan actually change their behavior so they continue to get those savings rather than rebound into higher energy consumption, we want to borrow a product from the financial world called an individual development account and pay families $1 for every dollar of energy savings achieved to participate in our program. It's a 2-year limited window. It is basically paying them for their outcome, not for their installation. And it is targeted to families below a certain income level. At the worst case, we will take a loan that's not bill neutral. This is kind of the bill neutrality line, and bring it way up to bill neutrality if we cap it at $1,000 a year. Anyway, so we are pioneering MESA. Right now we're in the middle of raising the match funding for it. Next slide. So the opportunity, if we get it right, this slide speaks for itself. We really are about increasing access to savings and pioneering it with a bold financial institution and a utility that have been willing to kind of painstakingly do what it takes to make this very low-tech line item happen. Thanks.
Thank you both very much for compressing very complicated subjects into very short presentations. So we'll have time for Q&A afterwards, but we're going to go on to Mia Kitahara. And I have the pleasure of working with Mia on programs in Alameda County, and she provides multifamily outreach for Stop Waste. And Stop Waste is a local government entity in Alameda County that leads the Bay Area Regional Energy Network's multifamily subprogram. Bay Area Multifamily Subprogram, yes. And the Bay Area Multifamily Building Enhancements, which offer rebates and free technical assistance, and manages the Bay Area Multifamily Capital Advance Program, which we're going to hear more about. Great, thank you. Give me one moment.
Thanks, Neil. That saves me some time having to introduce myself and our programs. We're going to switch gears here and talk about multifamily. We've been hearing a lot about single family. Multifamily is a little bit of a different animal, so I'm going to start off with talking about some considerations that are particular to multifamily, and then talk just briefly about what other products are out there, and then get into the details of the BAMCAP, the Bay Area Multifamily Capital Advance Pilot. So, great. I like to start off by talking about what gets me most excited, which are the actual projects. So this is a multifamily upgrade project, a typical one that we might see in the Bay Area. 52-unit low-rise garden-style project, did a lot of coming up to code kind of measures. It was a 1960s vintage, so roof insulation, water heaters, low-flow fixtures, refrigerators, indoor lighting, basically a lot of in-unit work also. Estimated cost was about $100,000 for this project. Next slide. This is also a multifamily upgrade project in the Bay Area. It's a high-rise, more urban, 320 units, or mid-rise, sorry, and it is relatively new construction, so the opportunities are less, so they're going above and beyond code here, and they're also focusing mainly on things that have direct payback to the property owner. So really high efficiency central boiler replacement, sophisticated boiler controls, LED garage and common area lighting. The estimated cost is about $500,000. So you see a huge range in multifamily. It's not as uniform as single family. So the financing products that are offered to multifamily have to be able to accommodate this diversity, both in kind of physical characteristics and the diversity in scopes that we might see, the diversity, the range, and the actual loan amounts that are going to be needed to be taken out, and also layering on top of that a diverse set of ownership structures. So you might have just a mom and pop that owns the property, or you might have a really sophisticated real estate investment trust. So essentially we need flexibility. So next slide. Also want to talk about how the multifamily space is residential in its functions, but it operates and finances like commercial. So the property owner is not taking out financing for their own living space. They're taking out financing for a profit-generating enterprise. So they have other considerations, financial considerations like net operating income, return on investment, and debt service coverage ratio, which come into the equation when lenders are underwriting these kinds of loans, in addition to the borrower's credit worthiness. Also, we have learned in multifamily, the first mortgage holders have a big hold on what the property owners can do with additional lending. So they either apply restrictions to supplemental loans that might be an energy efficiency loan, or a second lender would not want to have a second position against their first mortgage holder. So this told us that, number one, the underwriting systems and infrastructure are complex. We probably want to leverage that, and also that we need an open market model if we're going to accommodate all of these different lenders wanting to, work with their own portfolios. Next slide. And then also some programmatic considerations that we had when we were designing our program, in that we wanted it to kind of layer on top of the rebate programs, both the Bay Area Multifamily Building Enhancements program that we were running, as well as any PG&E whole building multifamily program that might be coming out. I think it's important to do it together because it's an integrated offering to the property owner, as well as leveraging the technical assistance and the QA that happens as part of the rebate program. That's something that we've heard in previous lending products, that's an extra cost. If we can embed it into a dovetailed program, that's all the better. Which basically meant that we needed a product that was easy to get up and running quickly, so that it could happen at the same time as our rebate programs. So to summarize, the financing product had to serve a diverse range of scopes and budgets. It had to align with first mortgage holders and be an open lender model, and it had to be set up quickly. We wanted to leverage existing infrastructure and processes of both the lenders, so the underwriting and origination, and our programs. So just to touch on the other things that are available or coming up in multifamily, we have the commercial PACE that Demetra covered for 5 or more units. That's available. The statewide IOU on-bill repayment is pending. So the master metered affordable housing pilot was approved through that same regulation that Lori talked about, and I believe that should be coming up in this year. There was also legislation, a couple of rounds of legislation proposed for OBR on tenant meters. This, unfortunately, it died, but this would have been really critical for addressing the split incentive issue, so that you can put the repayment for measures that benefit the tenant on the tenant's bill. We also have Pay As You Save, which is similar to OBR, but it's with water utility bills. We have pilots happening in the Bay Rand territory. And then I'm going to talk about the Bay Area Multifamily Capital Advance now. So this is not an original idea. I can't take credit for it. That was another reason why we picked it, is it had happened somewhere else before, and we had a good model to work off of. So Green Jobs, Green New York financing, administered by NYSERDA. They have a total budget of $11.5 million through 2015, and it acts as a revolving loan fund. And they could get more funding if they needed to. It was launched 2.5 years ago, and they've closed to date 14 loans, totaling $9.24 million. Of that, the NYSERDA portion is $2.8 million. The largest loan that they've closed is $4.4 million, and I'll have to say that includes non-energy work too. So I'll get into that in a little bit, but the smallest loan is $75,000. So again, you see this huge range of different loan sizes in the multifamily space. So next slide. Compared to that, our pilot is pretty small. We have a total budget of $2 million, $1.5 million of which is the capital pool that we can issue our portion of the loans out of. It launched in Q1. We're ready to take projects. We're currently in the recruitment phase. We're anticipating 3 to 10 projects, ranging, $100,000 to $500,000. We cap our portion of the loan at $500,000, so that we get at least 3 projects. So that small amount is not going to, revolutionize the market and serve all of the multifamily properties, but we will plan to facilitate some upgrade projects. We'd like to see if it will expand the scope, if the availability of low interest financing will expand the scope, or enable projects that are at a standstill to move forward. We also want to expose lenders in the multifamily lending space to energy efficiency projects. Right now, they're refusing to underwrite really to energy efficiency savings. 3 minutes, great. But this way, we hope to start building those relationships and getting them more familiar and comfortable with energy loans. So essentially, the capital advance pilot gives up to half of the cost of the energy efficiency scope that the borrower is borrowing at 0% interest, so that the combined interest rate issued by the lender and our 0% interest, it can be up to half of an interest rate reduction. So this is a very simplified version of a diagram that we've worked on. It's kind of faint, so I apologize for that. But essentially, the lender and borrower negotiate loan terms. If the lender accepts to participate with us, then our portion comes at 0% interest. Say that they had a 7% interest rate, the blended loan would be 3.5. So that's what the borrower gets, is a lower interest rate. We rely on the lender to do their underwriting and origination and issuing the funds. We give them our portion of the funds, and they also deal with the borrower in collecting the repayments. We get 50% of the principal that was collected. Obviously, no interest comes to us. And that goes to our servicer, and it goes back into our pool. So in theory, it could be revolving again. We could generate more loans. So it doesn't just disappear. And so far, we've seen that the New York program has had no defaults. So that's great. Just to walk through some steps of how this would integrate with the rebate program, they get the technical assistance and an approved scope through either our rebate program, or when PG&E's whole building program comes up, we'll accept those scopes. They access the rebates, and then the cost net rebates, we can fund up to 50% and up to 5,000 units or 500,000. 5,000 per unit or 500,000 per project. The rest of the interest rate is negotiated between the borrower and the lender based on their underwriting decisions, and then we just have to have the lender sign up to participate in our program. That's my timer. You didn't signal me. Oh, great.
I'll take the extra time.
Extra time, bonus time.
I know.
This is my last slide, so I'm good. So right now we're in the recruitment phase. We're talking both to lenders and borrowers. We're talking to lenders that have, really we're targeting kind of regional, medium-sized banks. Our pilot is probably too small for the nationals. But talking to ones that have multifamily portfolios, if they participate with us, they can already get on the pre-qualified participating lender list, and borrowers can pick from that list. They can also, these lenders can go to their portfolio of multifamily mortgages and try to recruit projects that way. We're also recruiting projects through the Bay Area multifamily building enhancements, technical assistance, and rebate pipeline, and trying to get them to talk to their lenders to initiate that deal. We saw that NYSERDA's program really worked that way. They recruited their lenders through their borrowers. So that's it. Yeah. Thanks.
Thank you, Mia. And our last speaker is Angela Hacker, who is with the County of Santa Barbara. She designed and manages the Empower Central Coast, a community building efficiency program serving Santa Barbara, Ventura, and San Luis Obispo counties, and leads other cross-sector sustainability community development initiatives. She currently serves on the statewide Energy Upgrade California Steering Committee and Santa Barbara County Workforce Investment Board. Angie has 13 years of experience creating solutions that advance economies, buildings, and resource efficiency at local, state, national, and international levels within nonprofit, for-profit, university, and government roles. Angie earned a Bachelor of Science in Applied Social Psychology from Cal Poly San Luis Obispo and a Master of Public Administration from the Wagner Graduate School of Public Service at NYU, with a concentration in policy and finance. Come on up, Angie.
All right, good afternoon, everybody. I'm Empower. I'm Angie with Empower Central Coast. I'm excited to be here today to talk to you about Empower Central Coast. Just a couple of weeks ago, I would have been here to talk to you about Empower Santa Barbara County, but just in the last few weeks, we officially have changed logos, and we're serving the entire Central Coast. So that means Ventura and San Luis Obispo counties as well, who are here at this forum, not in this room because they probably, oh, Trevor's here. You want to listen to it just one more time, right? But thank you, Trevor. I want to thank Ventura and San Luis Obispo for being really great partners. So I get to talk today about empowering a lasting energy improvement market by working with credit enhancements and credit unions. Notice I didn't say make a bunch of loans for a short amount of time. we're hoping to really establish something that has staying power. And so that's really the goal behind Empower and sort of the bigger pictures, something that won't be vulnerable to having the rug pulled out from under us when funding dries up or next time FHFA sends a nasty gram. So I'm going to talk to you a little bit about how we're working closely with the private sector. And as you heard from Commissioner McAllister, we've got big goals here in the state, and we actually have $60 billion worth of retrofits that we need to make in California. We estimate in Santa Barbara County we have to make about $650 million in retrofits, and as we all know all too well, governments aren't going to be able to afford to pay for those. IOUs, maybe, no, they probably don't want to do it either. And of course, consumers themselves don't have that amount of money sitting in their piggy banks, so bringing private capital to the table is incredibly important. And at Empower, we don't just bring them to the table, we give them a nice big hug. Next slide, please. So Santa Barbara County designed the program a few years back, and it's designed to help owners and builders overcome obstacles to improving existing buildings. And of course, our goal is to lower energy use and support job creation and economic development. And our vision for the long term, like I said, is a sustainable energy improvement market that can support safe, efficient, and comfortable buildings throughout the Central Coast. And in order to do that, it really is sort of a market transformation opportunity. So we're not running just a program at Empower, we're running an experiment. How can we take these sort of amorphous blobs of interest in this market and pull them together in structured products and services so that people can actually make their way all the way to an upgrade? And so we do that in a couple of different ways. We're handling both sides of the market scenario at the same time. The first I'll talk about here is the market demand side, so driving demand with homeowner services. I'm not going to talk a lot about it, but say Judy Smith in Ojai in Ventura County can now take advantage of incentives up to $6,500 in partnership with our IOU friends with Energy Upgrade and other rebate programs. We have our low interest unsecured loan I'm going to spend some time talking about today. She can also take advantage of our qualified contractors, personalized customer support, which actually are human beings at the local level at all three counties who are there to help people navigate through the process. Community education, lots and lots of community education, and of course we have our on-site expert energy advisor. That's our energy coach. I'll talk a little bit more about how well that product is working. And then we're working on the other side, so not just engaging the demand, but engaging the workforce, getting those other market actors in place. And so we have a lot of services for our contractors to help them participate and really help perform high quality, affordable improvements. So anything from training to free tool lending to mentorship with our energy coach. So that's kind of a high-level overview of what we're doing for our area, and I wanted to mention that first because that's kind of the context that financing falls into. So financing is one of the services we're offering, but it really isn't all that effective all on its own. You have to have these other kind of comprehensive services around. Not surprisingly, people don't just go jumping for joy when they hear that there's a loan available. But I do want to talk more about our loan. So the Empower financing product, we actually started off as a PACE program. Interestingly enough, and then when FHFA came around and didn't have nice things to say about it, we went off and built our own product with credit unions, like I said, with credit enhancements. And so really we know that rebates out there right now are pretty good, but they're not always enough to achieve affordability. A lot of homeowners around the state are doing, if there's a whole house retrofit that's necessary, it could cost $20,000. Our rebate's going to take a portion of that off, but it's not going to cover the full amount, and how will they pay for it? So we have realized over the course of the last few years that loans really must be affordable, accessible, and convenient in order to attract consumer participation. With credit enhancements, we're able to get to that point. A few years back, there really wasn't a lot of products happening in California. There weren't a lot of lenders willing to engage, and now we've got 2 lenders in the Central Coast that are willing to work with us because we're offering them credit enhancements. And so in exchange, they're offering us very below market home energy loans that they otherwise wouldn't have dipped their toe into at all had there not been this sort of subsidy provided to warm the market for them and really attract them and say, okay, can we make this work? Let's test it out. And what's so great about one of the credit enhancements is a loan loss reserve, is that if there is a default, that just means that the county can cover up to 90% of the cost of that default. So it really lowered the risk of lenders who are interested in testing out this new market. And that allows us to establish some demand and establish some metrics in terms of how well these loans can perform. So we can hopefully at some point establish that there is a separate asset class that performs really well for this market, and other lenders will engage at some point as well. if you can hit that one more time, there you go. So we went through a competitive solicitation process. We reached out to a lot of financial institutions, CDFIs, large institutions, and credit unions really seemed at the time to be the best fit. They saw the value proposition to be most valuable to them, and there was this local-to-local approach that really seemed to mesh really well. And so they have been a really great partner for us. So we're working with Coast Hills and Ventura County Credit Union, and we're able to leverage the funding that we received from the Department of Energy through the Better Buildings Program, through the California Energy Commission, and now through SoCal Gas. Thank you, Frank, back in the back there, for helping us support our loan loss reserve, which is actually at this point for the Tri-County is at $2.8 million. And so we, through our negotiations with our lender, have been able to leverage that 20-to-1, meaning that the private capital available for our region is $56 million. And it's all traditional unsecured loans, meaning that none of our funding is part of the loan that is made. It's not subject to any of the risks associated with it. But the loan loss reserve is only expended when there is a default. So theoretically, when all that money is already spent, there's probably going to be some left over. We can revolve that again and use it for an additional tranche of funding. So this is what we ended up with after our negotiations. It was a pretty attractive product, and I put it alongside a couple of the other products that homeowners might have access to but typically aren't using. So our loan type, like I said, is unsecured. That has a lot of benefits. We heard before that unsecured loans will allow folks to not have to use their equity for the purpose of a home energy upgrade, but use it for something else. Our rates are actually now at 3.9%. We are doing an interest rate buy down for a limited time for Santa Barbara County residents, so we're very fortunate to have a low rate at that level. You can compare that to a typical unsecured loan. It'll be 13 to 30%. So this is pretty amazing. Our loan size is up to $25,000. We're actually interested in growing that as well. The term's up to 15 years. Again, a typical unsecured product is about 5 years, so this is really a way to bring down the monthly payment for folks. Another interesting thing about the Empower product, there is no collateral required, no equity required, no closing costs, no fees, no prepayment penalties, and the approval time is really quick, a day or less, and we can go as low as 590 in terms of the FICO score. The credit worthiness does control the rate. So I wanted to talk thank you, a little bit about some of our successes so far. We've had a lot of outreach, a lot of marketing done, and we've done a good job of really creating widespread homeowner action and awareness. So we've done about 100 workshops so far, and that's just with Santa Barbara County's live program in the last couple of years. We've had about 4,500 interested individuals actually proactively contact the program because they're interested not just in the financing, but all the services that we're offering. So far, we estimate that we've got about 375 homes that have done some kind of home energy activity in them. We've actually had 200 energy coach site visits. That's kind of the first step for a lot of folks who want to get started with an energy upgrade, but they don't know what to do. And so we've created the energy coach service to create an easier on-ramp so they know a little bit more about what they can do to improve their home. 81 projects complete so far, averaging 30% energy savings, another 45 or so in the works. And I'll tell you, I'm not pleased with those numbers. So we've been doing a lot of work in the last year to do whatever we can to increase the uptake of our program, and I'll talk a little bit more about what we're doing to change things a bit. But I do want to talk for a second about our energy coach. Just a quick highlight here for those of you who are working on residential energy efficiency. It's really difficult to get somebody from interested in efficiency to actually contacting a contractor. There's this big gap. We call them our refugees, and we have to go save them. And so we built this energy coach program so that they have somebody to work with, and then they're far more likely to work with a contractor. So in the 200 visits that we've done in homes in Santa Barbara County, in the last 16 months, we've had 75% of those folks then contact a contractor. Of those folks, a third of them have either completed a project or have one in progress. So we're pleased with that early level of conversion, and we expect that to actually lead to additional work in the future. I think I'll go ahead and, I'll talk a little bit about, we've had $1 million in loan applications to date. Of that, we know that there's the average loan size is about $19,000. Average income of our borrowers is $86,000. It ranges hugely, so low income, high income, everybody's sort of interested in the product. We've had no defaults to date, and we're learning that about 15 to 25% of the people who want to go forward with an upgrade are interested in the Empower loan. We're actually hoping to take a larger portion of that market share as well. Next slide, please. So some of our new recent enhancements to the loan product, I mentioned the expansion. So we're now able to serve 315,000 single-family homes throughout the Central Coast. Really excited about that. Super excited about Simi Valley, some of the hotter places. Santa Barbara, really terrible weather. It's really nice. We actually built a progress payment option for our contractors. After a lot of input from them, they said, cash flow is still an issue for us. Our typical loan process was to complete the loan at the end of the project, so that meant that the contractor had to float the entire amount. So now we have a project progress payment. We created a reamortization option, which just means if you prepay without penalty, instead of shortening the term of your loan, you'll actually be able to keep the term that you had and lower the monthly payment. So again, another way to lower the monthly payment. And I mentioned eligible energy efficiency measures on here because we're really interested in expanding the type of improvements that are eligible for our loan. We've heard that a few times today. You can go to the next slide. That's one of the key lessons that we've learned. To get to any kind of reasonable volume, to keep the private sector wanting to participate in this, we need to have access to a lot of choice, and we need to actually listen to our consumers. What they're demanding are not whole house necessarily. A lot of folks want to do things incrementally, and so we should make it easier for them to get started and to get some of those improvements they're actually willing to do. And so we're working closely now with SoCalGas and our utility partners to develop something that will allow folks to do single measures and hopefully more measures as they go. A couple of other just quick points. Financing a loan, great, necessary, as we've heard today, not a silver bullet. It has to be done alongside some of these other comprehensive services. We know that the market is transforming. I'm seeing more competition happen in the market already, but it also is clear to me that there is still a need for subsidy. This is tepid waters still for lenders. There hasn't been a huge showing of demand quite yet to say everybody's going to get into this market. But at the same time, governments really kind of need to be thinking about whether or not, what message they want to be sending to the private sector. Do we say, come on in, we're going to warm the waters for you, we're going to help? Or are we going to say we're going to create a lot of different products and we're going to compete with you? So what's the impact of that? And that's it. Thank you, everybody.
Wow, there's a lot of questions, I'm sure, out there. So we're going to use the microphone for all the questions.
Hello, Susan Wright, San Mateo County. When we're saying it's a 3% loan or a 7% loan, are these compounded or is it just the straight interest rate?
Straight interest rate.
It is.
Typical, like a traditional loan.
Okay.
It's straight. Also, I think there's a variation in whether different FICO scores get the same, whether it's a minimum interest rate. I don't know if yours varies. Some of them are, in our pilots, it's the same regardless of your income or FICO, and it's straight for the whole term of the loan.
The multifamily interest rate will depend on the lender. We leave that up to them.
And I will double check with Barbara. God, there's a lot of noise from next door, sorry. I will check with Barbara, but my understanding is that the HERO program is also straight, and the commercial PACE programs that exist right now are straight.
All right, Ross Clark from the City of Santa Cruz. One comment first, reducing program criteria is really an important consideration. In a nice climate like Santa Barbara, Santa Cruz, a lot of our interested parties don't qualify and they go away discouraged, and that's not a service to them or to the programs we're trying to develop. So anyways we can develop these with less minimum criteria is very valuable. Are you talking about
measure eligibility or?
Yes, or just to be able to apply. And then my question is, in Santa Cruz 50% of our residents rent, and what programs or ideas are out there to get to the property owners that are different than the actual tenants?
Are they multifamily or single family?
A lot of them are single family.
Our program had to start somewhere, and so we wanted owner-occupied homes. Statewide, especially post-housing crisis, there are a lot of renters in single-family homes, and we need to address the challenge, but we couldn't with our small pilot.
With Empower, we do offer it to other than owner-occupied. You can be a renter. You have to be the property owner, but it doesn't have to be owner-occupied. We're not seeing a lot of those just because the incentive isn't there for them.
I'm only going to speak to Santa Clara County, and again, we don't have that kind of percentage. Is skewed more towards owner-occupied, but rental is what we're looking at. And as we expand our programs and perhaps into a residential PACE program, we work very heavily on all of our programs with our property assessor and their data bank. And we have found that in all of our programs, including our codes and standards and outreach to contractors, as well as homeowners and building owners, using a letter directly from us, also partnered with our cities, really moves the marketplace or the end user, the target audience.
So I spoke about tenant spaces in the multifamily context, but I think OBR could be a key instrument to getting over that split incentive.
This is for Mia. On the multifamily, have you heard from the property owners? Are they passing along the savings that they anticipate seeing from the improvements of doing their buildings, or are they charging back the financing to their renters? I'm curious if the renters are going to see, reduced costs because of the improvements they're putting into the multifamily. If you've heard anything,
Okay.
or any discussions on the property owners.
Well, we haven't closed any of the loans yet so if I can't speak to whether they're passing on the financing costs and costs in general. If they're not rent restricted, they could be passing on some of the cost of the improvement. The savings, I don't think anybody's passing through the savings to the tenants. If it's accruing to the tenants' bills, then they automatically see the savings. But if it's accruing to the master meters or the central meters, the property owners just are going to keep that as part of their expense reduction. And to pay back the loan, yes.
Besides Empower, I just want to find out from all your programs so far, has there been any foreclosure or any defaults from any of the property owners so far since the start?
We could hear that she's asking about the default rates on our programs. I can tell you right now that I've done a lot of search. I seem to be the go-to PACE girl for the past year. I've done a lot of research on the programs that are ongoing since the beginning, starting with Sonoma's. And actually, the default rate is statistically insignificant. And these programs, starting with Sonoma, have been operating for 3 years. So the default rate is very, very low. And that's probably another reason why private equity is now becoming so attracted to the residential market.
I'm going to take the opportunity and ask a question. Do you have plans to evaluate the actual level of savings achieved in these projects?
Energy savings?
Yeah.
Well, I can speak for our program that we're piggybacking on the rebate programs, which have the modeled savings. Because multifamily is difficult with data access, we won't be able to necessarily do utility bill tracking, but that is a component we're interested in.
Yeah. Similarly, with Empower, we've been piggybacking on the Energy Upgrade California program, and then we'll continue as we roll out single measures to develop an estimation for our energy savings.
I'll go. So our pilots haven't launched yet in terms of borrowers. To the extent that we fund, that the loans fund Energy Upgrade California loans, they will piggyback on existing infrastructure on measurement and verification of savings. On the single measures, it's more complicated, and we're trying to figure out the right administrative approach to track. And separately, the bank is developing a whole tracking on loan performance, which is a different element. And remember, part of what we're trying to prove is A, that the loans succeed, and B, that they catalyze and increase the marketplace. So there's a whole set of savings and loan performance data that Union Bank will be managing on that aspect of the equation.
I'll be quick. Yes, as to the residential, commercial obviously is. And as to residential, since Hero, Sonoma's been doing that because they've had access to the bills as well. But also the Hero program is currently in an analytics, sampling and analytics measure. They already measure a lot of metrics. The energy savings metric is currently being worked out.
I'm just curious if you have, hello, any specific resources for local governments where they could maybe aggregate all of these great resources that are available in their communities. It seems like there's kind of a suite of options that are available, and a lot of times we're the ones that are having to message that to the sectors that you're describing. So is there a one-stop shop that we might be able to utilize besides Demetra in our county who does that for us, but for others in the room?
It's a really good question. We don't want to confuse borrowers. We want to maximize borrower choice, and we all benefit by whatever financial model is taken. But we are working. And I forgot to say that eFLIC is right now only available in PG&E territory. That was the authorization. But our pilots are early, but there is room for other pilots and other banks to come in, or for our pilot to grow. So we are in the process of figuring out how to best develop collateral that can protect borrowers, give them good information, understand the risk. Anyway.
And Aaron, the pilot for eFLIC in Santa Clara County will go through the same thing. We'll be doing, coordination with all of the cities and our local efforts. So.
For the multifamily, actually the other piece of our program, the Bay Area Multifamily Building Enhancements that has the technical assistance, that TA is the one-stop shop that we like to think of. We'll direct to any different variety of programs, the PG&E, single point of contact, as well as financing programs. And I have that list up on one slide, and they can direct them to the various financing products depending on what's appropriate for them.
I work for CCSE, California Center for Sustainable Energy, and we have a website that lists both the different financial products up and down the state that you can click on. And then we also have a PACE map, which shows all the PACE providers. We're going to add Empower to it. And so you can also click on that and take a look, and then you can contact us, and we can walk you through. We also have a PDF guide, which we did for Pasadena Water and Power, and that PDF guide walks you through residential, commercial, and municipal, and talks about all the different programs up and down the state, and then you just pick up the phone and call us, and we'll get you to the right person to get the information you need. It's www.energycenter.org/finance for the finance page, or /PACE for the PACE page.
It sounded like the Empower program had a high participation of Energy at Break California projects, maybe going away from that in the future, but could the other programs speak to how much you see Energy at Break California, or how many, what percent of projects are Energy at Break California?
Well, if you're obviously talking about the residential market, so the residential market in Hero, for example, and it's anticipated as well for California First. As you know, if you're implementing EUC, and I did ask the contractors this, I said compare the two programs, because all the contractors that I pulled and surveyed, there were quite a few, are implementing both. They said you have to understand that the Hero program is just more flexible, it's more dynamic, it's more user-friendly for the consumer. It's something that is absolutely more, can be handled. My EUC contractors have to spend 3 and 4 hours every night doing paperwork. And that's a cost that they have to hand off to the consumer. So we're artificially inflating the cost of these EUC projects. By contrast, and they're staying static. By contrast, the contractors that I spoke to that are dealing at Hero, and they've been there for around a year, one gentleman, and he was pretty symbolic, owns his business. He had 23 employees a year ago. He has over 100 today. And these are middle income jobs. So, they're not overlapping. Hero is basically the, kind of go-to of choice, where Hero is for one reason or not really compatible with the consumer. They're opting to consider Energy Upgrade California, but they're not yet merged. I will say that a couple of local governments were included, and the LGSEC is also working to see if we can reach some kind of accommodation with the CPUC where we are able to leverage the program. So it's a good question, a timely one. Keep posted.
And the reason we need PG&E's help for this is because our pilots access ratepayer funds for credit enhancement, where Hero isn't dependent on ratepayer funds for credit enhancement. And we hear not only kind of the hero model, but from counties like Fresno that we're partnering with, that families want to, and from what Angie talked about, families really want to phase in implementation and not do whole house, as much as whole house would be better. And so we've been really surprised and excited that PG&E is willing to be more flexible in this loan program, in that the loan can be used to finance anything that is allowed under the residential rebate catalog or an HVAC replacement. It's just that you're gonna be limited in your rebates. You aren't going to be eligible for the more substantial EUC rebates if you do that, but you can get the financing. And I guess I'd turn it back to all of you. Is that sufficient? Does that get us to single measures? And maybe that's your strategy also in expanding to whatever's in the residential rebate catalog. Does that help, or are there still other barriers? You know, I'd love to hear from you. What are the true barriers, and how can we pour over financing that really helps eliminate those barriers?
It does, financing is a great assistance, and to answer the gentleman's question of how many projects, I know in the Energy Network area and first in LA County, we've completed over 250 loans that are all supporting energy upgrade, what used to be called Energy Upgrade California, now Home Upgrade. But that took a lot of credit enhancements. You know, that you need to make the product so enticing to contractors that they're willing to do that extra paperwork.
Yeah, if I can just add to that, the current residential PACE program, the consumers don't care about the enhancements under Energy Upgrade, the incentives under Energy Upgrade California. The flexibility and answering their needs is far more important.
Can I chime in on that one too? I've done a lot of research on some of the programs throughout the country that had the Better Buildings dollars, and a lot of them will offer a whole house approach versus a single measure approach or an a la carte approach, and the amount of success and volume that they see really only comes from the programs that are seeing a lot over here in the single measures. I haven't seen a whole lot of success in terms of high volume financing programs that are using this whole house approach on its own.
I would agree, yeah.
I'm wondering how any of these products are or programs are connecting with homeowners who are doing other remodeling, and how that pieces together. Can you only finance the part that is related to energy, or how does that work?
Well, as you can imagine, with the current Energy Upgrade California program, it becomes a little bit more complex, and there's more paperwork to definitely document the difference, because you're only going to incent, obviously the energy efficiency measures. With HERO, as you saw on the, they do allow a kind of range of measures that include water and other measures.
And OBR has a 20% non-energy limitation. Whether they could do more, we would have to figure that out.
On multifamily retrofits, it often is part of a larger scope. So the Bay rent portion would only be limited to 50% of the energy scope, but they can negotiate their loan with their lender for however much they want.
With Empower, we're operating with 75%, 25% split, 75% being the improvement. So that actually comes from DOE Better Buildings rules.
So in the new CPUC pilots that were approved back in last September, which were mentioned, of course, it's actually a 30-70 split. So yeah, I just wanted to make clear that it's a 30-70 split, actually, that 30% can be non-EAMs, the eligible energy efficiency measures. But right now in the resolution process for those PIPs, and also in the future probably for through the CATFA process, there's going to be a determination of what actually falls under that 70% versus what's in that 30%. Because there seems to be an idea that it's possible maybe that within that 70%, things like asbestos removal and some of those ancillary things that have to happen with it, maybe not end up included actually in the 70, and then the 30 can actually cover other things. But I would encourage everyone in this room who's interested to probably participate in the CATFA process that will occur once, I believe I heard CATFA actually just got authorization through the budget process. I know it's happening. I don't know if it's actually passed, but as of July 1st, they'll have authorization to become the chief, and then they will make their rulemaking process that will actually determine the shape of the details of these financing products. So everybody should participate in that as if it were a CPUC proceeding.
Got time for a couple more questions? Yes.
Hi, Rachel Peterson with the CPUC. I appreciate all the CPUC-directed comments today, But Demetra, my question is for you. In discussions, or anyone, in discussions with contractors and the coming Title 24 update, does anyone express trepidation or concern that maybe some of the rate of adoption will fall off as a result of the code ratcheting upward?
I'll tell you what the bigger fear is on not just the contractors, but every single implementer that I've spoken to, and this goes, this includes the IOUs too, is that they're concerned that the existing conditions are not going to be considered as the baseline. Because what we're doing, if we do, hold fast as the new standard being the baseline, is then you will definitely, absolutely, not you personally, but we will collectively guarantee that even more work than what is already being done unpermitted will likely be done unpermitted, and it's estimated at 90% in HVAC at this point. I think you're going to force reputable, responsible contractors to maybe reconsider their reputable, responsible practices. No, I'm serious, because there's going to be too much competition in the marketplace that will undercut them. And we're also just really going to penalize the property owner, because what you're going to do is the gap between the new standard and a reach is going to be this big, but the gap between the new standard and where their home or building currently is this gap, and we're not rewarding them for this ambition. And I'm hearing that all over.
I mean, I think the way Title 24 updates will impact all these financing programs, or not all, but insofar as the financing programs are, and so the PACE is not included in this, but insofar as they're tied to the eligible energy efficiency measures within the actual portfolios, I mean, that's really how Title 24 will directly impact the financing programs, because it will impact what are eligible energy efficiency measures, right? So it's sort of a cascading effect, I would think. So as I said, PACE would not be impacted, but the other programs, any with the ratepayer credit enhancements, or anything that's actually tied to those being the measures that can be financed. So PACE is outside that, yeah.
Great. I'd like to thank the audience and the panel for a great discussion.
I just wanted to add, we're really excited to be in partnership with Union Bank, and they are a financial institution here in the room. And so if you have any questions or comments on our program design or outreach, you should feel free to ask Paul.